In this episode, I will explain the new day opening gap and how traders use it in the market. This concept is extremely powerful because it helps traders identify the daily bias and understand the correct order flow. Let's dive straight into it. So first, let me tell you what is new day opening gap. So new day opening gap is basically the gap between yesterday closing price and current day's opening price. So this usually happens at the yesterday's 4:59 p.m. candle. That is going to be your last candle of the day. And next, we are going to have the 6 p.m. candle. So the difference between these candles is going to be our new day opening gap first. Let me show you some examples of marking this out. So in the example, you can see we have this 4:59 p.m. candle. Now what I want to do is hover my crosshair above the candle, and you can see at the top left over here the open, high, low, and close price. So I want to mark a ray at the closing price of this candle just like this. Now I want to do same thing to next 6 p.m. candle. I want to hover my mouse over it. See the open, high, low, and close of this candle. But this time, I want to mark the opening price of the candle on the previous candle. We use the closing price. And this next candle, we use the opening price. Now I'm going to mark this with a ray like this, and now I can mark the high and low just like this. As you can see, the high like this and low just like this. Now we have our fully fledged new day opening gap. And you can also use the consequent encroachment of this gap. You just have to use the fib tool for that, just like this. Now let me show you some more examples of it. In this example, we can once again observe the formation of a new day opening gap, and the process of marking it remains exactly the same as before. There is no need to apply anything different or overcomplicate the approach. Consistency is key when working with this concept. As shown, we identify the final candle of the previous trading day, which provides us with the closing price. This closing price acts as one boundary of the gap. Then we move forward to the 6 p.m. candle, which represents the beginning of the new trading day. From this candle, we take the opening price, which forms the second boundary of the gap. So on one side, we have the closing price of the last candle, and on the other side, we have the opening price of the new day's first candle. By marking these two levels, we establish the core structure of the new day opening gap. From here, we can further refine the gap by identifying its high and low, effectively outlining the entire range. This allows us to clearly visualize the imbalance created between the two sessions. Additionally, marking the date associated with each new day opening gap can help in tracking and studying how price reacts to these levels over time, building a deeper understanding through repeated observation. At this point, you should be comfortable with identifying and marking the new day opening gap on your charts. The process is simple, repeatable, and highly effective when applied consistently. Now that we have properly defined and marked the new day opening gap, the next step is to understand how to actually use it in trading and how price interacts with these levels in real market conditions. When it comes to actually using the new day opening gap in trading, the key is not just marking one gap, but building a broader context around price. What I want you to do is have at least 5 new day opening gaps marked on your chart prior to the trading session you plan to trade. For example, if you are preparing to trade the New York AM session, your job before the session begins is to go back and mark the new day opening gaps that were formed in the days leading up to the current trading day. Ideally, you should have a total of 5 gaps plotted on your chart. This gives you a clearer picture of how price is positioned relative to recent imbalances. Now, you might wonder why we specifically use 5 gaps. The reason is that it allows us to identify a directional bias based on the distribution of these gaps around the current price. Once you have all 5 new day opening gaps marked, the next step is to observe where price is currently delivering. In other words, identify the current price range and then analyze how many of the marked gaps are positioned above price and how many are below it. This is where the concept becomes powerful. These gaps tend to act as magnets for price, meaning price is often drawn toward them. So, by comparing their distribution, you can form a directional bias. For instance, if you observe that out of the 5 marked gaps, only one is below the current price, while 4 are above it. This creates a clear imbalance. The majority of the gaps are sitting above price, which suggests that price is more likely to move upward to rebalance and tap into those resting gaps. In this case, your bias would be bullish. With this understanding, when the New York session opens, you can anticipate that price may first move lower to take liquidity, such as recent lows, before reversing and expanding higher. This move would target the new day opening gaps positioned above the current price, as they act like draw-on liquidity levels. In summary, by marking multiple new day opening gaps and analyzing their positioning relative to current price, you can develop a clear and logical bias. This approach helps you align with the likely direction of price delivery rather than trading randomly, giving you a structured way to anticipate market movement. To apply the new day opening gap concept effectively on your charts, you need to follow a structured and repeatable process. The first step is to mark out the new day opening gaps from the previous 5 trading days. This creates a clear framework that helps you understand where price is positioned relative to recent imbalances. Once you have these 5 gaps marked, the next step is to wait for the market to open. In this case, the focus is on the 9:30 a.m. New York session open, which is known for providing strong volatility and directional moves. At this time, your main objective is to evaluate where the majority of the new day opening gaps are located. As shown in the example, there are 2 new day opening gaps resting above the current price and 3 positioned below it. Additionally, price had already traded into one of the upper gaps during the 8:30 a.m. move. This is an important observation because it suggests that there is more resting liquidity below price than above it. Based on this distribution, the logical conclusion is to adopt a bearish bias, meaning we should be looking for short opportunities. With this bias in mind, we then shift to execution at the 9:30 open. At this point, price fills a 1-minute fair value gap and shows a change in the state of delivery, indicated by a bullish candle. Shortly after, price forms a newly presented fair value gap around the open, which provides a precise area for entry. Using the bearish bias derived from the new day opening gap analysis, a short position can be taken at this fair value gap. The targets for this trade are the lows below, which align with the resting new day opening gaps and act as draw-on liquidity levels. As the trade plays out, price moves smoothly toward these targets, demonstrating how effective this approach can be when bias and execution are aligned. Notably, price continues to deliver into the new day opening gap formed on January 5th, respecting it as a key level. This reaction further reinforces the strength of these gaps and highlights their importance in understanding price behavior. In conclusion, the new day opening gap is not just a tool for marking levels. It can be developed into a complete entry model. By combining the distribution of multiple gaps to determine bias with precise entry techniques, such as fair value gaps and changes in delivery, traders can create a highly structured and reliable approach. This concept simplifies bias identification and allows you to trade in alignment with the natural draw of liquidity in the market. And that's how you use the new day opening gap, not just to mark levels, but to build a complete trading model, from bias all the way to execution. If you found value in this, make sure you stay consistent with it, backtest it, and really understand how price reacts around these gaps. That's where the real edge comes from. If you enjoyed this breakdown, make sure to like, share, and subscribe, and I'll see you in the next one.